not financial advice. I'm recording my thoughts about Snowflake. Snowflake stock is down about 10% today and it's currently trading at about $157 with a market cap of about $57 billion. If you have been following me, you know that I sold my Snowflake position at $184 for a 30% gain. At the moment, I do not own Snowflake stock, but since the stock is down to $157, I have to evaluate whether I can buy the stock again or not. In this video, I'm going to talk about Snowflake's business model. We're going to look at some numbers and finally I'll do the valuation. Snowflake, as we know, offers a cloud-based data platform. As you can see on the screen, if you have unstructured, semi-structured or even structured data, you can pass it through the Snowflake's ecosystem and you can get useful insights as well as predictions. So how do we know that Snowflake has a great product? For that, we have to look at certain metrics like dollar-based net retention rate. This company has dollar-based net retention rate of about 151%, which is phenomenal. And they have customers across multiple industries, and you can see some of the reputed companies that are Snowflake's customers. And Snowflake is also growing its revenue significantly. So that tells us that Snowflake has a good product. In the most recent quarter, Snowflake also increased its gross margin from 74% to about 77%. And they're saying the expansion drivers are product improvements, scale, and cloud agreement pricing. We all know that Snowflake uses a consumption-based model. Stock is down if Snowflake is great. So the main reason for this is the financial year 2024 guidance, in which they're only guiding for 34% revenue growth. Not long ago, this company was growing its revenue in triple digits and over 60%, and all of a sudden we see 34% growth rate, and that spooked the investors. Let's quickly look at their financial statements. When you look into their revenue, it's split into two different segments. There is product revenue and there is professional services and other revenue. But as you note, the product revenue is almost 95% of the total revenue, so we can assume that the product revenue is same as the total revenue. And you can see the stock-based compensation is about $258 million. That's almost 12% of the total revenue. That is a significant amount. Let's now quickly look at Snowflake's valuation to make a decision of whether to buy the stock or not. As usual, I'm going to show two cases, one with reasonable assumptions and the other with great execution. In the reasonable assumptions, we know for the fiscal 2023, they are making about $2.6 billion of revenue. So I'm assuming 30% growth rate. In the most recent year, they are saying about 35% revenue growth rate, right? So I'm assuming 30% growth rate for the next few years. And this is also in line with what the management has said. The management has been saying that they're aiming for $10 billion of product revenue by 2029, which signifies 30% year-on-year growth. So I put the same number here, with which Snowflake will make about $8.5 billion of revenue in 2027. This company's gross margins are in the order of 77%, so I'm assuming 25% net profit margin, with which this company would be making about $2.12 billion of net income. I'm going to assign a multiple of 30, which is a premium multiple, and with that, this company would be worth about $63 billion. With respect to the number of outstanding shares, this company has about 325 million outstanding shares at the moment, but they have been offering stock-based compensation and not buying back. Therefore, I'm assuming 2% dilution in the next few years, with which this company will have 348 million outstanding shares. When I divide the market cap with the number of outstanding shares, I get a price of $183 in 2027. The current stock price is about $157, right? So that's 16% gain, which is a really bad gain. So based on the case with reasonable assumptions, this is not investable. Now let's look at great execution case. In the great execution case, I put 35% growth rate in the next few years, which is more than what the management is saying. And I put net profit margin in the order of 27.5%, which is reasonable for a company which makes close to 80% gross margins. And I also put a premium multiple of 32.5. I assume the same dilution, with which this company will have a $258 stock price in 2027. Currently they're at $157, so that's about 64% gain, which is a decent gain. So in the great execution case, we can make a decent gain, but in the base case, we cannot. For my personal journey, I will not touch this stock until it drops to about $120 or less, and then I will think about starting a position again in Snowflake. Please provide any feedback. Thank you so much for watching.